Hi, everyone. Welcome to A View from the Floor here at the New York Stock Exchange. I am joined here by a very special guest. We have Jordan Ricciardi here from UBS. And let's start talking about the tech space for a moment as we begin here. Everyone says that we are in a tech bubble, but is AI the real deal this time?
It probably is one of the most asked questions we get. Is the AI boom right now similar to the tech wreck 2.0 back in the 2000s? But I do want to point out one stark difference between valuations back in the 2000s by the big tech names versus now. Back then, they were trading at a 70x forward multiple. Today, they're trading at more of a 30x multiple. Not to say a 30x multiple is not high relative to the broader market. It is. But we don't think stock prices fall because valuations are high. We think stock prices fall because the corporates are not beating on the earnings that they've set out to beat, which they have so far, and that's why the stock price continues to go up. But now more than ever, AI is going to have to continue to walk the walk and prove to both the private and public sector the path to ROI. Overall, UBS is still bullish, constructive on the sector, and we're still advising clients to actually get into the space if they're underrepresented.
Well, despite these bubble fears, UBS is actually raising the target price of the S&P 500 approximately 7% going into June of 2026. Why is that?
Yeah, so UBS raised their price target to 7,300 for June of next year, as you've pointed out. And we did this because we think that the productivity boom garnered by AI is still grossly underappreciated. If you look at the first half of the year, we had tariff uncertainty, we had sticky inflation, and corporations still beat on earnings. They were able to look through the smoke. And so when you look through the smoke and you see the future, what you're seeing is deregulation coming, which is going to boost deal making, and you're seeing us entering a rate cutting environment. And so when you look at historical returns of the S&P 500 since 1970, when we're not in a recession, it returns 12% annually. When you look at the returns when we're not in a recession and we're in a rate cutting environment, it's more of a 15% return, which is really good. That's why UBS has raised their price target and why we remain constructive on equities.
Believe it or not, it is already Q4 and we're looking ahead into 2026. What are some of the sectors that UBS is focused on when you're looking ahead?
Yeah, it's a great question, and it's crazy. We're already planning for a year ahead. So we, on top of the information tech, the AI, we like healthcare. The reason we do is we believe there's an aging population that's really going to need more healthcare, more drugs, more elderly care. And so that's going to boost the stock price even more, not to mention there's this increased demand on weight loss drugs. And you're seeing weight loss companies continue to innovate, going from injections to the pill form, which again is increasing demand for these types of medications. We also really like financials. As I mentioned, the deal making that's going to come from deregulation, the lower interest rates is going to increase borrowing, it's going to increase R&D, and it's ultimately going to boost the economy even more. So we like financials as well.
Well, there's always going to be some point of uncertainty or volatility. So how important is it to always have a goal of a long-term financial plan and making sure that you have it right?
This year, more than ever, I would say we're getting calls from clients with anxiety over what's happening in the market. We experienced a bull and bear market in just a few short months. We were up 30%, we were down 30%. And so you can imagine that there's a lot of calls from clients of how's my portfolio doing? Should I sell out of the market? That's where we take an opportunity to refer our clients back to the financial plan, which is really at the heart of financial advisory in the first place. But remind yourself, why are you invested in the assets that you're invested in? Have your goals changed? Because if they haven't, your portfolio really should not change. You must stay the course. It's the investors that ran away from the market, put their money in cash during those volatile moments that are probably kicking themselves right now because their portfolios have underperformed. So again, we like to work with investors that lean into that volatility, actually buying the assets that have fallen down, because those are the investors that will outperform and the financial plan that will help them do that.
Jordan, thank you so much for your time and thank you for the insights.
Thank you, Michelle, and thank you, Asset TV.
And that will do it for us here at the New York Stock Exchange. I am Michelle Yu, and we'll see you next time here on Asset TV. Take care.